Brent crude slipped after Tehran signaled peace talks, but the Strait of Hormuz problem has not cleared. That is the tension for oil markets. A diplomatic headline cooled prices, while the physical shipping route stayed under stress. Brent dropped more than 1% to $94.44 after a 5.6% rally. West Texas Intermediate also moved lower during Asian trading. Oil traders were not reacting to a solved conflict. They were reacting to a possible path toward talks, while the main supply route still looked vulnerable. The price dip came after Tehran privately indicated it would send representatives to Pakistan for another round of talks with Washington. The public message was still tougher, with Iranian leadership resisting negotiations under pressure. That split matters because markets can react to even a hint of diplomacy before the details are real. For crypto traders, this is a macro story rather than a token story. Energy shocks can affect inflation expectations, risk appetite, and how aggressively investors hold volatile assets. That is why the same headline can be bullish for risk assets for a few hours and still leave the broader market tense. A negotiation signal helps sentiment. A closed route hurts supply. Hormuz remains the hard constraint. The strait normally handles about 1/5 of global crude supply, and transit was still described as effectively halted. Only 3 vessels attempted to move through early Tuesday. That means the market is not just pricing speeches. It is pricing whether barrels can physically move. Oil markets can ease on negotiation hopes, but shipping data is the practical proof that the risk is actually falling. The Strait of Hormuz is a real-world choke point, not a chart pattern. When it is restricted, ships, insurers, producers, and refiners all have to adjust at once. Gulf producers have already adjusted. Saudi Arabia and the United Arab Emirates shifted more operations toward bypass routes, including Yanbu on the Red Sea and Fujairah in the Gulf of Oman. Those alternative terminals raised aggregate loading capacity to 6.5 million barrels per day, up from 5 million before the conflict. That helps, but it does not fully replace normal Hormuz flow. A workaround reduces damage. It does not erase the bottleneck. That gap is why alternative routes matter for price, but do not fully calm the market. They provide capacity, yet they still force a different logistics chain during an active conflict. The ceasefire clock adds pressure. The temporary ceasefire between Washington and Tehran was set to end Wednesday evening Washington time, and an extension was described as unlikely. Citigroup projected crude could reach $110 per barrel if Hormuz disruption lasts another 30 days. That is not a guaranteed price path. It is a stress case that shows why one blocked shipping lane can keep risk assets nervous even when talks are being discussed. A 30-day disruption case is useful because it measures duration risk. The longer the route stays blocked, the more the market has to price inventory stress rather than just political headlines. The next real signal is not a single headline about optimism. It is whether talks begin, whether the ceasefire survives, and whether Hormuz traffic normalizes. Oil markets dipped because diplomacy looked possible. They can stay fragile if ships still cannot move and naval enforcement continues. For crypto viewers, the useful takeaway is that energy pressure can tighten the macro backdrop even when the crypto catalyst is happening somewhere else. For crypto, this can show up indirectly through dollar strength, inflation fear, and reduced appetite for risk. That link is macro pressure, not a direct blockchain catalyst.